Have you ever wondered why some investors always seem to win, while others are stuck losing year after year? What's their secret? Are they just lucky? Or do they know something you don't? If you're just starting out, or even if you've been investing for a while, there are mistakes you could be making that are holding you back from building real wealth. In this video, we shall dive into 11 investing mistakes that keep people broke in 2025 and how you can avoid them. Let's get you set up for success in 2025. Mistake number 1, blindly following stock tips. Here's the first mistake, blindly following stock tips. How many times have you heard someone say, "This stock is about to skyrocket. You better jump on it now"? You see it on social media, YouTube, and maybe even hear it from a friend or family member. But here's the problem. You're trusting someone else's opinion without doing your own research, and that's dangerous. You don't want to be caught holding the bag when the stock crashes just because you followed someone else's tip. The truth is, you need to understand the company you're investing in, its fundamentals, its industry, and its potential for growth. Just because a stock is trending doesn't mean it's right for your portfolio or your financial goals. It's so easy to get swept up in excitement, but investing is not about jumping on trends. It's about making informed, calculated decisions. Let me ask you, how many times have you jumped on a stock just because someone recommended it and then regretted it later? I know, it happens to the best of us. But here's the thing. If you do your research and understand why you're buying something, you'll feel a lot better about holding it through any market fluctuations. Practical tip. Before you buy anything, spend 30 minutes researching the company's earnings report. It's all right there for you. You'll be amazed at how much you can learn in that short time, and it could save you a ton of money in the long run. Mistake number 2, not having an investment plan. Next up, not having a plan. Imagine setting off on a road trip without a map, right? You wouldn't do that, would you? But that's exactly what you're doing if you're investing without a plan. If you're just throwing money at stocks and hoping for the best, you're going to end up lost and, more importantly, broke. So many people think they can just wing it, but without a roadmap, you'll have no idea where you're going or when you've arrived. How will you know when to take profits, when to cut losses, or if you're even on track to hit your financial goals? A lack of planning can lead to hasty decisions that cost you big. And trust me, I've seen it happen. Think about it. What's your end goal? Is it a comfortable retirement? A new house? Financial freedom? Whatever it is, you need to know why you're investing in the first place. And that's where your plan comes in. How many of you have set specific financial goals for your investments? How do you track your progress? Practical tip. Sit down with a pen and paper and write out your investment goals. It's so simple, but it'll give you clarity and keep you on track. You can even use personal capital to map out and track your financial goals, making sure you stay focused. Mistake number 3, ignoring fundamental analysis. Now, let's talk about ignoring fundamental analysis. Have you ever been tempted to buy a stock because everyone is talking about it or because it's trending? That's a huge mistake. If you're not diving deep into the numbers, you're gambling, not investing. And gambling is a surefire way to lose money. It's easy to get caught up in excitement when a stock is making headlines or everyone on social media is hyping it up. But if you don't understand the business behind the stock, you're setting yourself up for failure. Real investing is about understanding what you're buying and why it makes sense for your portfolio. When you don't understand a stock, you're literally leaving your future in someone else's hands. So, how well do you really understand the companies you're investing in? Do you know how their revenue is generated or what challenges they might face in the future? Do you know their debt level? Practical tip. Start with the earnings reports, 10Q. Then check out their cash flow, debt, and overall business strategy. Spend 30 minutes reading the annual report. It's all public info, and it'll give you a much clearer picture of the company's health. Mistake number 4, not understanding key metrics. This one is crucial, not understanding key metrics. So what's a P ratio? How about EPS or ROE? If these terms sound confusing, you're not alone. But here's the deal. If you don't understand these numbers, you're not ready to invest in individual stocks. If you don't understand the P/E ratio, for example, how will you know if a stock is overpriced or undervalued? How will you know if a company is growing or slowing down? These metrics aren't just for financial experts. They're tools you need to use to make smart decisions. When you skip this part, you're basically flying blind. So, how comfortable are you with terms like P/E ratio, earnings per share EPS, and return on equity ROE? Do they make sense? Or are you a little lost? Here's the thing. Learning these metrics will give you a huge edge. They're like the GPS for your investment journey. Without them, you're just guessing. Practical tip. Take 5 minutes each day to get familiar with these terms. Start with Yahoo Finance or Morningstar and check the metrics of the companies you're interested in. Mistake number 5. Relying on tips, not books. All right, let's be real here. Relying on tips instead of educating yourself is a mistake many beginners make. We all love a good YouTube video or social media post promising the next big stock. But here's the problem. Those tips are just that, tips. They're not a strategy. If you only rely on tips, you'll never develop the skills needed to analyze a stock on your own. You'll always be at the mercy of someone else's opinion. That's why reading books and educating yourself is non-negotiable. Do you have any favorite investing books? If not, it's time to start. Books like The Intelligent Investor by Benjamin Graham and One Up on Wall Street by Peter Lynch are classic reads that teach you how to think about investing, not just what to buy. Practical tip. Set aside 30 minutes every day for reading about investing. Over time, that will add up to massive knowledge that'll give you a real advantage in the market. Mistake number 6. Quitting when things go down. Let's face it, the stock market isn't a straight line. It goes up, it goes down. But quitting when things go down is one of the most common mistakes I see. If you're pulling your money out every time the market dips, you're locking in your losses. And that's not how you build wealth. The thing is, the market will always fluctuate. It's part of the process. If you sell every time things get rough, you'll miss out on the long-term gains when the market recovers. Have you ever been tempted to sell during a dip, only to regret it when the market bounced back? That's the danger of emotional investing. Instead of panicking, consider dollar-cost averaging. This means investing a fixed amount every month, no matter what the market is doing. When the market dips, you're actually buying more for your money. Practical tip. Set up automatic contributions to your investment account. This way, you'll be investing consistently, no matter how the market is performing. Mistake number 7. Investing in what you don't understand. This is one of the biggest mistakes. Investing in things you don't understand. If you're jumping into a stock or industry just because it's trending and you don't understand the business behind it, you're gambling, not investing. If you don't understand the business model, the products, or even the industry trends, you're taking a huge risk. It's like trying to drive a car without understanding how it works. Sure, it might get you from point A to point B, but what happens when something goes wrong? How comfortable are you investing in industries or sectors you don't fully understand? If you don't understand it, don't invest in it, unless you're willing to spend time learning about it first. Practical tip. Stick to what you know. Or if you want to branch out, do your homework first. One easy way to do this is by investing in ETFs or index funds that focus on sectors you're comfortable with. Mistake number 8. Investing money you can't afford to lose. This is probably the most basic mistake. But investing money you can't afford to lose is something a lot of people do without thinking twice. You shouldn't be investing your rent money, your emergency savings, or money you need for short-term expenses. Investing should be for the money you don't need in the next 5 to 10 years. If you're worried about needing the funds soon, then that money should not be in the market. It's that simple. Practical tip. Build an emergency fund first. Make sure you have 3 to 6 months of expenses in a savings account before you even think about investing. Only then should you invest money you won't need for the foreseeable future. Mistake number 9. Not diversifying your portfolio. Diversification isn't just a buzzword. It's a critical strategy to protect your investments. Not diversifying means you're exposing yourself to too much risk. If one stock or sector crashes, it takes your entire portfolio down with it. So, how diversified is your portfolio? If you're all in on tech stocks or a single sector, you're leaving yourself vulnerable. Diversifying across multiple sectors, asset classes, and investment types is key to reducing risk. Don't put all your eggs in one basket. Spread them out across different investments. Practical tip: ETFs and index funds are perfect for diversification. They allow you to invest in dozens, even hundreds, of companies with just one purchase. It's an easy way to diversify without being a financial expert. Mistake number 10: failing to be patient. This one's a biggie: not being patient. Investing is about long-term gains, not quick wins. If you're expecting to get rich overnight, you're going to be disappointed. The key is to stay consistent and let your investments grow over time. So, how often are you checking your portfolio? Too much? If you're constantly looking for quick returns, you're missing the bigger picture. Successful investors don't react to every little market fluctuation. They focus on the long term. Practical tip: stop checking your portfolio every day. Instead, make it a habit to review it once a quarter to see if it's still aligned with your long-term goals. Mistake number 11: panic selling during market dips. And lastly, panic selling. The worst thing you can do is sell everything when the market dips. Sure, it's hard to watch your portfolio shrink, but selling during a dip locks in your losses and means you're not giving your investments a chance to recover. If you panic, you're selling low. Solution: stay calm. View a dip as an opportunity to buy stocks at a discount. Don't let emotions drive your decisions. Stick to your strategy and know that the market will recover over time. And that's a wrap. 11 investing mistakes that can keep you broke in 2025 and how to avoid them. Avoid these mistakes, stay disciplined, and your financial future will thank you. If you found this video helpful, make sure to like, share, and subscribe for more tips and insights. Drop a comment below and let me know which of these mistakes you made or are worried about making. Also, if you want to learn more about investing strategies, let me know, and I'll make more in-depth videos to help you out. And as always, take control of your financial future one step at a time. And remember, investing is a marathon, not a sprint.